Alright guys, welcome back to the channel. This is video 3 in this series on journaling, so if you missed the other two, go and watch those first or this one won't make much sense. In this video, I'm going to share something that I've not seen any other trader speak about online anywhere before, and that's self-review. At the end of this video, I'm going to share something that will instantly help your trading improve immediately after watching this video, so make sure you stay for that. So why am I spending so long on this topic? Well, this is the only thing that will allow you to generate long-term consistent profits in trading. Anything other than that is just luck, and luck isn't repeatable for very long. So what I want to go through in this video is how to review yourself and your own performance when it comes to trading so you can constantly improve, which is what all great traders do. I'm going to cover incorrect trade sizing, excessive loss, taking bigger losses than your plan allows, execution errors, trades that you've entered that you shouldn't have, or trades that you missed that you shouldn't have, and management error, which is managing your trades incorrectly. And if you have a system to improve all these 4 things, you will become better and you will become a better trader, and I'm going to show you how to do that now. Firstly, incorrect trade size or position is where you've carried too much risk on a trade. So for example, if you have a risk management strategy that means you can only risk a maximum of 0.5% or 1% on any one trade, I'll keep the math simple. What you do is you go through all the trades that lost more than your maximum allowable, which is in this example 1%. So in this example I've shown that on trade 1 and 7 in my trade journal, and then next you add up all of the total loss from those trades, which should you have executed flawlessly would have been 2%, 2 trades with 1% risk on each, then subtract the ideal from the error. So 4 minus 2 equals 2. That's 2% which you've lost as a result of incorrect position sizing or not managing your risk properly. So write that figure down in a section of your trade journal titled "Lost from my fault." Next is execution errors. This is where you go through each trade you entered in your journal and ensure that there was legitimate entries based on your trading plan. So this is where you literally open up your journal and you look at the first recorded trade and you bring up the chart on that market that the trade was taken on, and you take note of the date that you entered the trade and the strategy that triggered the entry, and then you compare it to the relevant chart and see if it was in fact a real entry. And you want to use your strategy checklist to confirm or reject the trade. You might have heard this process referenced as reviewing the tape. All great traders do that after every trading session. Now I get this might sound pointless and time consuming to some people, but it might actually blow your mind and blow you away with how many trades that you entered that you didn't actually meet your trading strategy. And the magic of looking back at your trades in hindsight is you have less emotional connection to the charts and the strategies, and that means you can actually see things differently now. You're seeing it from a third person perspective. So do that, and if the trade in hindsight was valid, give it a tick. If the trade in hindsight was invalid, give it a cross. For invalid entries that you lost money on, sum up your total percentage losses and add this to your lost from my fault tally. For invalid entries that you made money on, sum up your total percentage profits and add them to a gained from my fault tally. Because you can have invalid trades that make you money, and this isn't something to be proud of. It's something that you shouldn't celebrate. It's not replicatable, right? It's not a system. It means you broke the rules and failed to trade flawlessly. And as you know by now, a good trade doesn't necessarily make you money, and a bad trade doesn't necessarily lose you money. The purpose of self-reviewing is to calculate exactly how much you're making and you're losing compared to the pure strategy performing. So if anything, you want to lower your expectations and not raise them. So lastly on this, we need to ensure that you manage them all correctly. So if all trades were valid, check to see if they were managed correctly. If they were managed incorrectly, count up the amount lost to incorrect management and add that to the tally, and the same for the gains. Some of the most costly trading mistakes don't come from what you do, but rather from what you don't do. Missing a trade could cost you 3, 4, 5, or even 6% on missed profits, depending on the kind of move that you miss out on. Missing trades is actually a very common error to make for new retail traders. Lots of people talk about overtrading trading, but people rarely speak about under trading, which is trades you should have been in but weren't. And as I say, it's very common in beginners, especially when they're trying to juggle their lifestyle around their trading. So this is where you, again, open up your charts and start at the first market that you trade in your plan and analyze the last week or 10 days or month, basically the period that you're conducting the review on, and you check any setups that occurred. Then go back to your journal and make sure that you took the trade. And if you did, then great, move on to the next pair until you go through the entire portfolio of markets. If you find that you missed some trades, write that down in the gains and the losses from fault tally. And remember, don't forget the losses. And then once you've done all this, you've now got a comprehensive list of all gains and all losses from faults in a separate column of your trade journal. The next thing to do is to analyze that data. You want to simply add up all of the gains from fault and subtract the total gains from losses, and that will give you a net performance discrepancy. And this shows the degree of human error in your trading performance. If your final result is -2%, then you've essentially realized a 2% loss on your account, which is entirely attributable to your human error. A performance discrepancy of -2% means that your account is now -2% to what it should be had you traded your strategies flawlessly. To calculate your strategy's true performance for the period in question, you would need to add 2% to your realized return. Likewise, if your final result is +2%, you've essentially gotten lucky. Had you been trading your strategy flawlessly, your account balance would be 2% lower than what it is. Professional traders seek to approach 0 net performance discrepancy each month. This means that you are trade sizing properly, making no faults, taking each entry with military grade accuracy and consistency. Now, important point here. This is the point that I mentioned at the beginning. Make sure you understand this. Sometimes you'll arise at a situation where your total gains from fault are equal to your total losses from fault. And this can produce a net performance discrepancy of 0. And that could give you a false sense of security that you're actually trading well. So 0 net performance discrepancy is an indication that your total profit and loss is equal to that of your strategy's true performance. However, to calculate the total magnitude of your own personal errors, you want to focus on gross performance discrepancy. Gross performance discrepancy can be calculated by adding every individual fault from the previous steps that I've just been over: excess loss, position size errors, missing trades, taking trades that you shouldn't be in, manage them incorrectly, then add a positive number to all the errors. This will give you a gross performance discrepancy. Gross performance discrepancy cannot have a negative answer. So your job is now to simply get a score of 0 every single month, which means you're trading your plan flawlessly. Make sense? If you want the downloads on this, click the link in the description and I'll give you all of the notes and the formulas and the calculations along with some examples so you can see how this will work wonders for your trading. This is what professional traders do, but no one talks about it because it isn't sexy. But remember, what gets measured gets mastered. So in the next video, I'm going to be talking about the truth about discretion and how you can actually use it to become a better trader and how I use it. If you're not already subscribed to the channel, be sure to sub and hit the notify bell to not miss that one. And until next time, thanks for watching. Take care. Let me know in the comments what you do for self-review, and I'll see you then.